The report finds that the blended finance market continued to grow steadily in 2024, despite macroeconomic challenges, including net capital outflows from emerging markets and declining official development assistance. Following a record annual $24 billion in aggregate blended finance in 2023, blended finance flows in 2024 reached $18 billion, which remains higher than all years since 2018. Climate continues to be a dominant priority in the blended finance landscape. More than half of all blended finance deals over the past decade have been climate-focused, accounting for over 62% of total financing in 2024. Encouragingly, we see that blended finance deals are increasing by size, with the median deal size increasing from $38 million between 2020 and 2023 to $65 million in 2024, which reflects growing ambition and scale in deployment. The growth in aggregate financing is driven by an increase in billion-dollar-plus deals, which increased from just 5 $1 billion-plus deals per year on average in 2020 to 2022 to 7 deals in 2023. The trend continues, with 3 deals launched in 2024 already closed. The report also finds that buy-in from the private sector into blended finance is growing. Commercial capital from private sector investors outpaced DFIs and MDBs in capital deployment, with $6.9 billion in investments in 2024. The shift towards larger deals is promising, but scaling blended finance requires more than just deal size. A lack of standardization continues to slow the rollout and replication of blended structures, and in many cases, concessional capital mobilizes public commercial funding from MDBs and DFIs rather than private investment. While the blended finance market has shown continued resilience, the current report looks at data from 2024 and thus does not reflect some of the recent challenges impacting the blended finance market, such as global ODA cuts and the dismantling of USAID, which will no doubt be felt in the market this year and beyond. As development aid constricts, the rationale for stretching the public dollar through blended finance will only grow. We hope this gets reflected in the market. Past the publication of this report, we will be monitoring the market closely and reporting on what we see.
In this year's report, we review what progress has been made in the last 5 years against the 4 key challenges to blended finance achieving scale. These include the lack of private sector mobilization strategies amongst most donors, the need for better local capital mobilization, the urgency of transparency, and an underdeveloped ecosystem for blended finance. We discuss the picture as it stands in 2025 and make several calls to action that the development community can take to continue to move blended finance towards scale. The first challenge we review relates to how donors have not prioritized and budgeted private sector mobilization as a necessity when it comes to significantly narrowing the SDG financing gap. Progress on this front has been rather mixed. We've seen unprecedented ODA cuts since 2024, which are likely to continue. And with the withdrawal of the US from the aid community, baseline ODA levels potentially being diminished significantly going forward, and the amount of ODA allocated towards blended finance still limited, the resurgence in blended deal volumes that Convergence has recently been tracking may be threatened. Expanding the focus on private sector mobilization from non-governmental actors like foundations and boosting collaborative or coalition-led blended initiatives that can help to deploy catalytic capital more efficiently and effectively will be massively important to safeguarding blended finance in an environment of constrained ODA in the years to come. The second challenge we review relates to how representation from local actors, including developing country governments, regional development banks, and private investors, remains largely missing from the blended finance market. The picture in 2025, unfortunately, has not improved. Local investment in blended finance continues to be underrepresented in the blended finance market, accounting for under 20% of all blended finance investment across all regions. Attracting local institutional investors through local currency green bonds, building capacity amongst local financial institutions for green projects, and creating an enabling environment for blended finance through green taxonomies can help to mobilize local investors into blended transactions more effectively going forward. The The third challenge we review relates to how concessional capital providers rarely share financial terms or post-investment outcomes publicly, which limits the availability of evidence supporting blended finance as a development tool. While data transparency has seen some notable improvements, there are still major challenges with disclosure from ODA providers, DFIs and MDBs, private investors, and other funding sources such as foundations. Going forward, concessional and catalytic capital providers can require greater data transparency from private sector actors. Data transparency should also be embedded throughout every stage of a blended finance transaction. The final challenge we review relates to the lack of financial intermediation in the blended finance market, with SDG projects often too small to receive scaled investments, and limited repetition and standardization in the market overall. Today, private investors continue to be wary of emerging market investing, including through blended finance. Global investors have rich opportunities to place their capital within developed markets and still meet their impact and climate targets. Going forward, standardizing proven risk reduction models and deal structures can help to create assets that meet the fiduciary and regulatory obligations of the investors that hold vast pools of capital, and thereby deliver better quality financing for SDG initiatives in emerging markets in higher quantities. The current state of these challenges is all explored within the report, with special attention being given to the implications posed to them by a reduced ODA environment.